All right. Good afternoon. Welcome to our Weapons of Mass Construction. This is part four of a series catered to the construction industry. Today we're going to go over some current industry updates. Some of the topics that we're going to be covering have been covered in some of our other webinars, but a lot of what we will be covering is directly related to the construction industry. Wanted to reach out to our client base in the construction industry to give them some updates in the tax world and other just business world in general. My name is Nick Agrippino. I am in the construction niche here at Powers and Company. I'm also here with Mike Vanderhoof. I'll let him introduce himself quickly.
All right, good afternoon, everyone. As Nick said, my name is Mike Vanderhoof. I'm also in the construction industry here at Powers. I've been here about 4.5 years and excited to come to you guys with some information today.
All right, so with that, let's get started. Move to our first topic. All right, we're going to be starting with the Paycheck Protection Program. This has been the hot topic of the CARES Act and kind of moving through the COVID crisis. So we're going to start with just a general refresher of some topics and then kind of move into some current updates that we've been seeing. There's a lot of information kind of tossed in on a daily basis, and we're just starting to finally get some answers that we've been waiting on. Start off just eligible expenses for the PPP loan proceeds. So, most people have gone through the process, gotten their loan. So, now kind of what's next is what you can use these proceeds for, and then we'll kind of get into the loan forgiveness piece, after the money is spent. So, again, just a general refresher. This can be used for payroll, rent, utilities, which includes electricity, gas, water, telephone, internet. On the proceeds, kind of the general caveat is whatever you spend out of your PPP funds, at least 75% of this has to be used for payroll expenses, and the other 25% is your other expenses, such as your rent and utilities. So it can be higher than the 75%. For example, it can be 80%, but it has to at least meet the 75%. Also, with that percentage, that is just based off of the proceeds that you use, not your total initial loan amount. So if you got a loan for, say, $1 million and $800,000 of it, you just have to spend 75% of that $100,000 in order to, be eligible for full loan forgiveness. With the payroll costs, this is limited to $100,000 annualized payroll for each employee. So if you break out the $100,000, that works to about $15,000. So during that 8-week period, one employee can't, take over about $15,000 in wages and that be forgiven.
Nick, quick question for you. Now, you talk about the wages. What if the employer uses PEO? For those of you that don't know what that is, that's a professional employment organization, essentially just outsourcing and whatnot. What if the employer uses a PEO? Are the wages paid out by the PEO?
Yep. So that's definitely been a question that we've been getting from a lot of clients. A PEO is becoming a very popular method because it, so you don't have the payroll tax filing burden. We've been seeing PEOs come out with their own reports and providing that to the their clients to give to the bank. And these reports will also come into play when we're talking about documentation. And down the line having ducks in the row for being able to back up what you spent these expenses on. So the one thing with the PEO reports, I will say, is I have seen some of these reports that either have things on there that shouldn't be on there. So when you're getting these reports, if you use a PEO, trust but verify is what I like to say. Run it past your CPA, accountant, to make sure, what on that report is accurate. Because most of these reports that are being generated are being done by the PEO, and, they might not necessarily have the expertise to do them 100% properly. Kind of going off what I just said as far as documentation goes, when people were originally applying for this loan, most of the documentation included, past payroll filings, and such, basically back up what they originally qualified for the loan. So a lot of the documentation is going to, it's a little bit different because, payroll tax reports would include 3 months. So really a payroll tax report isn't going to give you much information because the covered period for the loan forgiveness is 8 weeks. So, if you have to kind of cater payroll reports, payroll reports that you're getting from a payroll company or you're doing internally, it's just important to, have whatever calculations and such that you came up with, just document it really well. As far as, documentation goes, right now as it stands, the SBA gave guidance last week that most of the loans that they're going to be going back and looking at, auditing, are over, if you got a loan that was over $2 million. So, but with that in mind, if you're under the $2 million, I would just say do the documentation anyway, because you never know down the line if they're going to reduce that threshold, if they're going to later decide that they're going to audit. So, all right. So now we'll do the loan forgiveness a little bit. So essentially, the loan forgiveness, what they're going to do is they're going to compare your full-time equivalent to one of two choices of periods. Either you can use February 15th, 2019 to 6/30/2019, or the other period that you can use is 1/1/20 to 29/20. So this is going to be, one of those two periods is going to be case, to get your full-time equivalent employee count. There's a little bit, into the calculation that we're not going to get totally into with, if you have part-time employees, the calculation's a little bit different based on hours. So once you calculate your full-time equivalents for one of those two periods, then there's going to be a comparison to your full-time equivalent employee during your 8-week period that these expenses are eligible for loan forgiveness. So essentially the initial thought, is basically hard for keeping 100% employment, which is obviously the goal of the PPP program, to keep people off unemployment, to keep people employed for when this crisis kind of pick up where businesses left off. Now, with what I just talked about with the full-time equivalent, there is a safe harbor out with. If your employment dropped during this 8-week period, basically, if by 6/30, so the payroll period including 6/30, you then hire back the employees that were furloughed or laid off, then you can still get full loan forgiveness. So you could go through the 8-week period and have a drop in employees, but as long as you hire them back by 6/30, you could still be eligible for anything that you spend.
Nick, quick question. You talk about these dates, you're looking at them in terms of the loan forgiveness. You're looking at these covered and alternative covered periods. Do the dates there apply to just the payroll costs that you're spending, or the other costs as well?
So for the dates, this is only related to, for loan forgiveness purposes, it is only related to payroll. So kind of one thing that we skipped over a little bit is during these 8 weeks, you're going to have expenses you incurred, but during the 8 weeks, but then they weren't paid until after the 8 week period. So for payroll purposes, you might have a payment go out after your 8 week period, but you can still apply for loan forgiveness for that. So for things like utilities and rent, this is a little bit different because it needs to be in that 8 week period, but it is very similar where, for instance, if just before you got the loan disbursement, you just had paid your rent, but so if you got your loan on a Monday, but then your rent is due the Sunday before, you can still basically at the end of the day, you need 8 weeks of expenses for things like rent and utilities. As long as you're using 8 weeks, it doesn't really matter if it was paid during the 8 week or just incurred. 8 weeks is so what you can't do is you can't fit 3 months of rent payments, for example. You can't take just 2 months of a period. So now we'll get into, because there's going to be situations where basically you have this outstanding, balance on the loan. Maybe you got $1 million loan, but you only spent $500,000 of it during the period because, you waited till that 6/30 date to hire all your employees back. So if that happens, now you have the decision of, keeping this loan or just paying it back simply. So the initial loan term is 1% over 2 years, which is pretty good, kind of from a business decision standpoint. If for say you have a line of credit that's at a 5 or 6% interest rate, you might opt to pay this loan over the term instead of drawing on that line. So it's kind of it's really what kind of position are you in? There was also a bill that moved through the House, which doesn't sound like it's going to get passed, but one of the potentials in that bill that could kind of take away for some future bills is talk of extending that 2-year loan term to a 5-year loan term instead, which would definitely, I think open up a lot of doors of opportunity if, businesses aren't sure if they would be able to meet that 2-year loan period, but maybe they'll be able to meet the 5-year term. All right, the last topic on the Paycheck Protection Program that we're going to talk about is taxability. Initially, when this loan came out, it seemed pretty clear in the way that the law was written that any loan proceeds that were forgiven would be tax-free income. So basically, there is a disconnect between the IRS stance and the intent of the law. The IRS came out and said if you get loan forgiveness per Section 280C, that you can't deduct the expenses that you used that loan forgiveness for. So on one foot, they say, yes, it is tax-free income, but at the end of the day, the expenses, it almost isn't tax-free income. It'd be the same, result at the end of the day, however you look at it. If you can't deduct the expenses, your income's going to be higher. So, that's how it is right now. We're kind of hoping, in the future, there's going to be a battle between, I know the AIC is involved, Congress, disagrees with the IRS because it was pretty clear, in the initial bill that this was supposed to be tax-free money for helping businesses out. So hopefully we'll get some relief for that in the future.
All right, and I'll be taking over for the next section of the webinar here. We're going to discuss the qualified and technical correction that made it through in the CARES Act. So essentially, we're going to look at this in 3 time periods. We're going to look at how qualified improvement property was treated prior to the TCJA. The TCJA is the Tax Cuts and Jobs Act, for those that don't know, that was enacted at the end of 2017, the big income tax reform that we received. The second period we're going to look at is the enactment of the TCJA, and the third period is going to be the technical correction that came with the CARES Act. So prior to the TCJA, qualified improvement property had 4 categories. There was you called qualified improvement property at the time, qualified leasehold improvements, qualified retail improvements, and qualified restaurant property. I'd like to note that none of these categories applied to residential property, so for sake of simplicity, I'm going to refer to these as just commercial improvements, as you can see on the slide. Prior to the TCJA, these commercial improvements were considered 15-year depreciable property, and this 15-year depreciable property was eligible for 50% bonus under Section 168K. Most of these improvements were not eligible for Section 179 either, with a couple exceptions there. Now, the big piece here is when you make these improvements to property, to non-residential property, that's going to be a 27.5-year recovery period. What this did before, when it was 15-year depreciable property, was obviously shorten the time period that you could recover your capital expenditures over, and made it eligible for bonus. Now, with the enactment of the TCJA, definition came about for qualified improvement property. There's actually two things that happened with the TCJA. Qualified improvement property took on a new meaning, and 100% bonus depreciation active.
And just to clarify really quick, when Mike talks about bonus depreciation, he's talking about initial expensing in the first year. So when he says % bonus depreciation, that means whatever the cost was, you can take 100% as a deduction in the first year.
Thanks, Nick. So for the new definition I'm discussing, the TCJA defined qualified improvement property as any improvement to an interior portion of a building that is non-residential real property, as long as the improvement is placed in service after the building was first placed in service by any taxpayer. There are certain things that were excluded, such as expenditures for enlargement of the building, elevators, escalators. Anything that affected the internal structural framework of the building was excluded. When the TCJA was enacted, Congress kind of had an unintended mistake when they passed the bill. So they developed this new definition for qualified improvement property. They forgot to include the verbiage necessary for this qualified improvement property to have that depreciable life that it used to have. So just as I said, the benefit of the 15-year life was a quicker recovery period. Without that language in the TCJA, the group went back to being a 27.5-year recovery period. What happens there was essentially now we're no longer eligible to take bonus on the property. Bonus depreciation at 100% expensing in the first year is only eligible for assets with a life of 20 years or less. So in the absence of any technical correction, qualified improvement property now had a 27.5-year depreciable life, and this prohibited bonus depreciation from being taken on, 39-year depreciable life, sorry about that. This prohibited bonus depreciation from being taken because, as I said, the recovery period was not greater than 20 years. Although the QIP was not eligible for bonus after the introduction of the TCJA, it was eligible for Section 179 expensing. And the third tier we're going to look at here is the technical correction that occurred with the CARES Act. There were many requests by the AICPA and various other accounting authorities that wanted Congress to go back and essentially place a technical correction there to now change the recovery period from 39 years to 50 years. This would now make it eligible for that new 100% bonus depreciation. Finally got this technical correction after 2+ years, and this was made retroactive to tax years beginning on or after 1/1/18. If you already filed your 18 and 19 returns, this opens the door for some great amendment opportunities, increased deductions. So basically, I mentioned the 179 before, and so 179 expensing is pretty similar to bonus. Well, there's one critical factor here that's different. With the Section 179, you can fully expense an asset in year one, but it's limited to your income. So the Section 179 deduction you receive cannot drive you into a loss. Whereas if you take bonus depreciation on an asset and take 100% expensing, that is not income limited. So at that point, you can actually push the business into a loss, maybe benefit from those losses on personal return. It opens the door for a great opportunity back. Nick's going to discuss that momentarily. And I kind of just wanted to walk you through a quick example here we have on the right. So as you see, we have a fact pattern on the right. We had $1.2 million of commercial real property that was already placed in service. The improvements were made in 2018. And for sake of argument, we have a taxpayer being in the highest income tax bracket at the time. So you can see before the technical correction was made, remember, this property now had a 39-year recovery period. It was not eligible for bonus. So you have your cost basis of $1.2 million. The first year, you're only getting a $31,000 depreciation deduction, resulting in a tax benefit of roughly $9,000. Now, after the technical correction, you have a cost basis of $1.2 million. You get to expense the entire amount using bonus depreciation. You save $355,000 there in tax. As you can see, it's a substantial difference. I mean, $346,000. We're not talking some change here, so this was huge. I know this is something we discuss quite often in our firm, and we obviously always stayed abreast of the current updates. We've been waiting on this technical correction, as I mentioned, for a couple of years. This was very big and opened the door for a lot of tax savings for our clients. So kind of piggybacking off of this, I mentioned that it was going to generate some great opportunities for NOL carrybacks. I'm going to turn it back to Nick to discuss these NOL carrybacks and some kind of the benefit and potential there.
Yep. So in the previous example, as Mike mentioned, the our tax benefit or difference, was assuming basically that you had income to take these deductions. Now, say this happened in 2018 or 2019, if you didn't have income, what you can do is, you can essentially create a business loss. With the bonus depreciation, you're not subject to your income, and you can create a business loss and potentially carry it. With the Tax Cuts and Jobs Act, they pretty much temporarily suspended the carryback period. So what the CARES Act did is it brought back this potential to carry back your losses. So if you had one of these, big projects going on in 2018 or 2019, what you can essentially do now is carry it back to what could potentially be a high income. Just the example that we put together here, in 2013, there was no qualified business income deduction, and the highest tax bracket 39 years. So you have a couple choices here. You can either carry forward your loss or you can carry it back to a higher income year. So it's going to be it really depends, what the future outlook is, what happened in the past, and then you're going to kind of see those options. And that's kind of, what our expertise is here. We're going to kind of lay out the two options for you. We'll talk about what the future holds for you or what holds under uncertainty. And then, kind of make a decision from there for going to benefit you the most.
Nick, so you talked about a carryback period of 5 years. So how does that work? You pick a year to carry it back to, or is it mandatory you go 5 years? How does that work?
So you have to at least go back to your earliest year that you can. So in this example, the earliest year is 2013. So in our example, this is assuming you had plenty of income to take that entire loss in 2013. But if there's any residual loss, you'd move to 2014 and offset that income. If you do the whole 5 years, there's a residual, you would simply carry forward that residual to future years, just like you would have if you kind of elected out of this carryback and just chose to move. And kind of one of the reasons, just to touch on really quickly, that we want to cover the construction industry is, not necessarily that this could create losses for business in the construction industry, but when there's a big project going on, this is definitely something that your clients are going to be thinking about when they're taking on projects, is what the tax benefit is going to be to them. So, you could see here in the future that if you're getting all these depreciation deductions, there might be a bigger push to take on a project like this if they can expense the entire project in the first year. And this carryback is also related to C corporation. as well as individuals. The example that we laid out is just for an individual that owns a pass-through entity, but it's very similar law to if you were operating C Corp as well. Right, now we're going to move into our next topic, the employee retention credit, which Mike is going to cover.
All right, so with the CARES Act came the enactment of the employee retention credit. We're going to start here with a little overview and eligibility on the credit. So the employee retention credit is a fully refundable payroll tax credit equal to 50% of qualified wages that any eligible employers pay their employees. So these qualified wages are any wages paid after March 12th, 2020 and before January 1st, 2021. I know I used the term eligible employer. We're going to ask ourselves, what is an eligible employer? So an eligible employer is essentially any employer carrying on a trade or business during calendar year 2020 that can qualify for the credit in one of two ways. So the first way is their operations would have had to be fully or partially suspended during any calendar quarter in 2020. Now this has to be a result of a governmental authority, an order by a governmental authority. This can essentially be any order that, say, limits commerce, travel, group meetings if it's pertinent to your business. So pretty much, therefore, any essential business would not be considered to have their operations fully or partially suspended, with one big exception here. Say you're a manufacturer and one of your main suppliers is unable to deliver some critical goods or materials necessary for you to operate. If indeed that is the case, then you would be considered fully or partially suspended, even though you're able to keep the manufacturing facility open. The second way you're able to qualify is if you experience a significant decline in gross receipts during the calendar quarter. Now, I want to note here, there is no requirement for a number of employees to be eligible to claim the credit. Tax-exempt employers are also eligible, and that self-employed individuals are not eligible for the employee retention credit with respect to their own self-employed earnings. However, they are eligible for any wages they do pay to their employees.
So Mike, what you're saying, if there's no requirement for the number of employees, if we had an employer that was, say over the 500 employees to be eligible for the PPP loan, they could take advantage of this credit.
So I'm going to touch on that a little bit later on, but you cannot double dip there and take the PPP loan and the employee retention credit. Now, I use the term significant decline in gross receipts. Yes, what is that? So basically, you're going to look at the calendar quarter in 2020 that you're in, and you're going to compare your gross receipts to the same calendar quarter in 2019. If your gross receipts in 2020 are less than 50% of your gross receipts in 2019, the same quarter, you are considered to have a significant decline in gross receipts. How long does this last as a qualifying factor to be eligible for the employee retention credit? So essentially, you have your first quarter that you fall below the 50%, but then you are eligible until the quarter following the quarter where you now have 80% or more than 80% of your gross receipts from the prior year. So I know it sounds a little complicated, confusing, so I'll give you guys a quick example here. Say in Q1 of 2020, I have 30% of the receipts that I had in Q1 of 2019. Now, in Q2 of 2020, I have 85% of the receipts I had in the same quarter. So I was eligible in Q1 because I was below the 50%. I am still eligible in Q2 to claim the employee retention credit because that's the quarter that I crossed that 80% recovery threshold, if you will. So then the third quarter, I would be ineligible. So the first quarter following the quarter that you hit that recovery threshold. A question that may come to mind here when we're looking at receipts, I know as tax guys, when we're looking at gross receipts often, there's a lot of aggregation rules. In short, there are aggregation rules that you do have to look at for gross receipts as a whole for aggregated entities, and this falls under some of the sections in IRC Section 52A or B and 414 M or O. It's a little down the scope of this webinar, but just know when you are analyzing these gross receipts for a significant decline, you do have to look at the control group as a whole. So now we're going to get into the calculation limitation a little bit. So determining the maximum amount of an eligible employer's employee retention credit. So the maximum amount an employer can claim is equal to 50% of the qualified wages that the employer pays in a calendar quarter. Now, the maximum amount of qualified wages that can be taken into account for each employee for all calendar quarters is 10K. So 50% of 10K, the largest credit an employer can claim for their employee is $5,000.
Hey, Mike, you keep talking about qualified wages. Can you brush a little bit on the definition of what is a qualified wage for this credit?
Good call. I should have touched on that. So essentially, qualified wages are basically all wages and compensation paid by an employer to an employee between that March 12th, 2020 date and before January 1st, 2021. Now, this also includes qualified health plan expenses, so long as they're properly applicable to the employee's wages. And this includes the qualified health plan expenses paid by the employer and paid by the employee, so long as they are a pre-tax salary deduction. So you got to think if it's a pre-tax salary deduction, that's going to reduce your wage expense and or your wages in box 1 of the W-2. It is actually a wage that you are paying to the employee. The employee is choosing to use that for health insurance. You're also able to use that as part of the wages. So there is one qualifier to this, though, I kind of want to elaborate on. Although there wasn't a specific number of employees that you need to be eligible for this credit, there is this 100 full-time employee threshold that kind of delineates the qualified wage notion here. So if you have an eligible employer that averaged greater than 100 full-time employees in 2019, qualified wages they can use for the credit are only the wages that are being paid to an employee that is not providing services. So essentially, if they're still being paid even though they're home due to this or partial suspension or the significant decline in receipts, for an eligible employer that averaged less than 100 full-time employees in 2019, the qualified wages paid to any employee, whether they're providing services or not. So they can still be employed by the company or they could be at home. Another question you guys may ask here is, I keep referencing 2019 when you're looking at these full-time employees. What if it's new business? Any business started in 2020, you will look at the average full-time employees in 2020. If you were open for 2 months in 2020, you're going to take your average full-time employees for each month, add them, divide by 2, and there you go. An employee will be counted as a full-time employee for any calendar month in which they average at least 30 hours of service per week. Again, there are aggregation rules that apply with full-time employees. If you're in a control group, you'd have to look at the employees for the entire control group. And that'll basically wrap up the calculation and limitation here. So now we're going to go on to how/where to claim the credit. As I mentioned, this is a payroll tax credit. So this payroll tax credit, you would claim this on your federal employment tax return. That's typically your Form 941 that's filed. In anticipation of receiving this employee retention credit, now remember, 941s are only filed quarterly. Most businesses are going to deposit with the IRS, weekly, depending on their pay schedule. So even though this 941 is filed quarterly, in anticipation of the business receiving the employee retention credit, employers are able to retain a piece of the federal employment tax deposits they would have made in the amount of the credit that they will be entitled to. And essentially, you reconcile you file the 941. If the employer is not able to retain a retention amount to cover the credit, in that case, there is a form the IRS released, Form 7200, and that form is used for an advance payment of employer credits due to COVID-19. This is one that can be claimed on there. So as I said, if you're going to be entitled to a $10,000 credit, but really you only had $8,000 worth of employment taxes to retain, you can take that other $2K and you can apply for that, get it ahead of time using this Form 7200. Oddly enough, this form can be obtained on the IRS website, but it is filed via fax right now. So, blast from the past. I know we handle a lot of tax notices. We still fax back to the IRS and such. and POAs, but hopefully you still all have your fax machines handy.
Yeah, it sounds like as a common trend of the CARES Act as a whole, it seems like they wanted to present opportunities for you to get cash now to keep your business afloat. With the PPP, the CARES Act, because a refund 3 months from now might not help as much as it will right now. With all the uncertainty, everything going on with the shutdown.
Absolutely. I mean, there's trying to get cash in the economy as quick as we can, get it in the small business, and allow them to stay afloat and weather the storm here. Great point. One last point I wanted to make on these retained deposits that I was discussing was when you retain these deposits, I mean, typically we all know like the trust fund penalties are pretty significant when you don't remit taxes over that you're supposed to deposit with the IRS. I just want to assure you, you are able to retain the deposits and will not be subject to a failure to deposit penalty. Those are pretty steep. I just wanted to throw that out there. Moving forward now, we're going to look at the interplay with the PPP loan. I'm sure some of you have read about this and whether you can take both. I know Nick and I touched on it a little bit earlier. It would be considered double dipping, and an employer cannot receive the employee retention credit if they receive a PPP loan. The one exception here is if the loan was repaid. If the employer repaid their PPP loan by May 18th of 2020, then they would still be eligible to claim the employee retention credit. And I know the slide just says the interplay with the PPP loan. I just want to mention a couple other little areas where the credits kind of brush up against each other. So you can claim the paid family and medical leave credit under IRC section 45S and the employee retention credit as long as they are not for the same wage payments. And you cannot claim the work opportunity credit and employee retention credit for the same employee period. So that's about all I have here for the employee retention credit.
Just one more quick thing with the 5/18 date. This is a date that we've seen a lot through this whole process. The reason being was, they've made a lot of changes to the PPP loan, and who's eligible, who's not eligible. So, when they came out with guidance, some employers who initially thought that they were eligible, but then they were kind of unsure, wanted to give back the loan, so, they didn't run into any issues down the line. So, if, going forward, there is a chance that this payback date could change, if any future guidance loan is enacted. All right. So moving on to our last topic before we open up for some FAQs. This won't take too long. The New York State reopening. So essentially, we found out over the last couple of weeks is there's going to be 4 phases of reopening. Most counties in New York State are still in phase 1 as of late last week, with the exception being areas down near New York City where they haven't seen a recovery as we have up in upstate New York. So I think all but 3 counties in New York State, if I'm not mistaken, are in phase 1, and basically to reach phase 2, basically you can't see a scale back in the numbers that they've set up, their deaths, hospitalization beds that are available. As as long as we don't see a regression, we should be moving into phase 2 in most places. So the guidance on what exactly changes from what is going to reopen more in phase 2 isn't exactly clear right now. Phases 3 and 4 are most definitely not clear. What is kind of awaiting for it in those phases. So this is kind of a work in progress, most definitely. What we do know is in the construction industry, most is able to be open for business, as long as follow the guidelines and restrictions set in place. So New York State has an online tool where basically you can look up your business based on your NAICS code, basically a code that says what specific industry that you're in. There's a lot of parent categories and then subcategories. So if you go and use that tool, and anything really related to construction is now open for business with restrictions. Some of these restrictions include, sanitation policies, distancing protocols, letting employees, work with, some distance requirements in there, maybe some masks in certain situations. So it's really kind of important to, understand those restrictions, so when you do reopen, you're not getting in any trouble with the law per se. But that's very reassuring for the construction industry in general, as far as who can now do business that wasn't able to do business before. So kind of as with anything, stay on top of current guidance. New stuff is coming out every day. As far as just, a business in general standpoint, what you definitely don't want to do is reopen your business and get some negative publicity for your business. Kind of any publicity in this situation is bad publicity. You don't want to be one of those businesses in a news article that, had a COVID outbreak or anything. Or at least if you do, you want to be able to say, hey, we took all the precautions necessary. I'm sure you've, read the articles that you see in the headlines every day. So very important as a branding of your business to make sure you don't fall into this category.
And as Nick said, obviously stay on top of all the updates. Coming to you with more webinars and posting more information on our social media. I'm sure you guys have been following us. We've been sending out a lot of email blasts regarding updates as we've received them, putting out webinars based on any new guidance we've received. So just keep your eyes peeled for our social media posts, and we'll be coming to you with these updates as we receive them. I'd like to open the floor now to any questions, if you guys do have any. I also do want to apologize. I did have a report that people were hearing a beeping on the line. I apologize if that was the case with the webinar here. If that's the case, we will be sending out a recording of this webinar to you and make sure that we can scrub that from there. So once again, we apologize for that. And if you guys have any questions, feel free to submit them in the chat box for us. We'll leave a second here. Well, it looks like we haven't received any questions as of right now. We're going to go to the last slide here, and we have our contact information. I will leave this up for you right now. We'll be sending you the slide deck. Please feel free to reach out to either Nick or I if you have any questions moving forward, any ideas, concerns, and